Let me tell you a secret that Wall Street spends billions of dollars trying to hide from you. If you are trying to be smart with your money, you are almost certainly going to end up poor. Most people think investing is a high-stakes game of poker, played in smoke-filled rooms by geniuses with 3 computer monitors and a direct line to the Federal Reserve. They think they need to find the next big thing, the next crypto coin, the next AI startup, or some complicated option strategy that sounds like it was written in ancient Greek. But after 80 years in this game, I've seen those geniuses come and go, usually leaving with empty pockets. The truth? The best investors are the ones who are sensibly lazy. I'm talking about a level of inactivity that would make a sloth look productive. If you find your heart racing when you look at your portfolio, you aren't investing. You're gambling, and the house always wins in gambling. Today, I'm going to reveal the 7 lazy investments that have allowed me to crush the market while barely lifting a finger. These are strategies that don't just survive inflation, they feast on it. We are living in a world where the purchasing power of your dollar is melting like an ice cube in the sun. If you leave your money in a savings account, you aren't being safe. You're being robbed. I'm going to show you how to build a fortress around your wealth using the power of compounding and the beauty of doing absolutely nothing. You don't need a high IQ, you don't need a fancy degree, and you certainly don't need to watch the news. You just need the discipline to be boring. Let's get into the first and most powerful weapon in your arsenal. I've been preaching about S&P 500 index funds for decades, and yet every year people try to find a way to make it more complicated. Simplicity is the ultimate sophistication. When you buy a low-cost S&P 500 index fund, you are essentially buying a slice of the 500 most successful, most productive, and most aggressive companies in the United States. You're becoming a part owner of Apple, Microsoft, Amazon, and yes, even my own Berkshire Hathaway. You are betting on American ingenuity, and historically, that has been the best bet in human history. The beauty of the index fund is that it's self-cleansing. If a company becomes stagnant or fails, it gets kicked out of the index. If a new revolutionary company rises up, it gets added. You don't have to pick the winners because the index does it for you. Over the long haul, the S&P 500 has returned about 10% per year. Now let's do some lazy math. If inflation is 3% and you're making 10%, your real wealth is growing by 7% every year. That means your purchasing power doubles every decade. And what did you have to do for that? Nothing. You didn't have to read a single balance sheet or listen to a single expert on TV. You just had to own the productive capacity of the country. But here is the catch, and there's always a catch. You have to buy the low-cost ones. I'm talking about Vanguard, Fidelity, or Schwab funds where the fees are 0.03%. Every penny you pay in fees is a penny that isn't compounding for you. Over 30 years, a 1% fee can eat up a third of your final nest egg. That's not being lazy. That's being reckless. The goal is to be a know-nothing investor. If you know nothing, you are already smarter than 90% of the people on Wall Street. Back in 2007, I decided to prove a point. I made $1 million bet with a group of hedge fund managers. I wagered that a simple, boring S&P 500 index fund would outperform a hand-picked collection of high-priced hedge funds over a 10-year period. These hedge fund managers are supposed to be the smartest minds in the world. They have the fastest computers, the best data, and they charge 2 and 20, 2% of your total money every year plus 20% of the profits. It sounds fancy, it sounds elite, it sounds like a great way to lose your shirt. After 10 years, the results weren't just clear, they were embarrassing. The boring index fund returned over 7% per year. The genius hedge funds, they limped along at around 2.2%. Why? Because of the friction of fees and the human urge to do something. When the market got volatile, the hedge funds traded. They tried to be clever. They tried to time the bottom and peak, and every time they moved, they lost money to taxes, fees, and bad timing. The lesson here is that in the world of investing, your biggest enemy is the person you see in the mirror every morning. You feel the urge to respond to the news. You want to protect your gains. But the lazy investor knows that the market is a device for transferring money from the impatient to the patient. If you can develop the stomach to watch your portfolio drop 30% in a year without clicking the sell button, you will be wealthier than you ever imagined. The index fund is your ticket to the top, provided you stay on the train until it reaches the station. Don't let the smart guys convince you that you need them. You don't. Now, I know what you're thinking. Warren, index funds are great, but what if the world goes crazy and inflation hits 10% or 15%? It's a valid fear. That's where Treasury inflation protected securities, or TIPS, come in. These are government bonds, and I'll admit they are about as exciting as watching grass grow in a drought, but they serve a very specific, very important purpose. They are a guaranteed shield against the loss of purchasing power. Unlike a regular bond where the interest payment is fixed, the principal of a TIPS bond actually moves up and down with the consumer price index. If inflation goes up 5%, the value of your bond goes up 5%. Then the interest you earn is calculated on that new higher amount. It's the only investment in the world where the U.S. government effectively says, "We promise you will never lose your purchasing power." TIPS aren't going to make you a billionaire. You aren't going to buy a yacht with your TIPS returns, but they provide the ballast for your ship when the stock market is volatile and everyone is panicking about the price of eggs and gas. Your TIPS are quietly adjusting in the background. They give you the peace of mind to stay aggressive with your other investments. A lazy investor doesn't want to spend their retirement worrying about the value of their dollar. TIPS take that worry off the table. You buy them, you hold them to maturity, and you sleep like a baby. It's the ultimate set it and forget it tool for the cautious part of your portfolio. There is a special group of companies out there that I call the aristocrats. These aren't just any companies. They are businesses that have increased their dividend payments every single year for at least 25 years. Think about what that means. To be a dividend aristocrat, you had to raise your payout through the 2008 financial crisis, the dot-com bubble, and a global pandemic. These are the Navy SEALs of the business world, companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. Why are these lazy investments? Because they do the work for you. When a company is committed to paying a growing dividend, it forces the management to be disciplined. They can't waste money on private jets or ego-driven acquisitions because they owe that cash to you. As a shareholder, you get a check every quarter. And if you're smart, and by smart I mean lazy, you take that check and you automatically reinvest it into more shares. This is the snowball effect. At first, the dividends might only buy you a few extra shares a year. It feels small, but after 10, 20, or 30 years, that snowball has picked up so much snow that it's an avalanche. You start owning more of the company simply because you sat still. These companies usually have moats, competitive advantages that allow them to raise prices when inflation hits. If the price of sugar goes up, Coke raises the price of a bottle. You, the owner, get to capture that extra profit. It's a beautiful cycle of wealth creation that requires nothing from you except the patience to let the snowball roll. I've often said that your personal home isn't a great investment. It doesn't pay you. You pay it. You pay the taxes, the insurance, and the guy who fixes the leaky roof at 2 a.m. However, income-producing real estate is a different story. But who has the time to manage an apartment complex or a shopping mall? Not a lazy investor, that's for sure. That's why I love real estate investment trusts, or REITs. A REIT is a company that owns, operates, or finances income-generating real estate. By law, they have to give 90% of their taxable income back to shareholders in the form of dividends. When you buy a REIT, you are becoming a landlord of hundreds of properties, data centers, cell towers, warehouses, or hospitals, without ever having to pick up a hammer. Real estate is a classic inflation hedge because as prices rise, so do rents. It's a natural adjustment. The best rats are the ones that own essential infrastructure. Think about the warehouses that hold all the goods for Amazon or the cell towers that power the phone in your pocket. These are businesses that aren't going away, and they have the power to pass inflation directly to their tenants. You just sit back and collect your rent check through your brokerage account. It's liquid, it's diversified, and it's completely passive. If you want exposure to the world of brick and mortar, but you value your weekends, REITs are the lazy man's path to real estate riches. Inflation is essentially a game of who has the power to raise prices. If you own a company that sells a product people need or a product they are addicted to, you win the game. This is what I call brand moats. Think about it. If the price of a generic candy bar goes up 20 cents, you might switch to a different brand. But if the price of a See's candy or a Hershey's bar goes up, you're probably still going to buy it for your sweetheart on Valentine's Day. This is investment number 5. High-margin consumer staples. These are companies with incredible pricing power. When inflation strikes, their costs go up, but they can raise their prices even faster without losing customers. This is why I've held American Express and Coca-Cola for decades. People don't stop using their credit cards or drinking their favorite soda just because inflation is at 4%. They might complain, but they pay. As an investor, you want to be on the side of the person collecting the extra quarters, not the one paying them. These investments are lazy because these brands have already been built over a century. They don't need to reinvent the wheel every year. They just need to keep doing what they're doing. You don't need to track the latest trends or the new tech. You just need to look at what people are buying every single day, regardless of the economy. If you own the brands that people can't live without, inflation isn't a threat. It's just a reason for your companies to grow their top line. They aren't making any more land. It's one of the few things in this world with a truly fixed supply. But I'm not talking about buying a plot of desert and hoping a city grows around it. I'm talking about productive land, specifically farmland. If you own a farm that produces corn, wheat, or soy, you own a factory that is powered by the sun and the rain. People have to eat. They will have to eat today, they will have to eat tomorrow, and they will have to eat in 50 years. Farmland is a fantastic, lazy investment because it has a very low correlation with the stock market. When tech stocks are crashing, the price of corn might be soaring. It provides a unique kind of diversification. Furthermore, as the global population grows and the amount of arable land shrinks, the value of that land naturally increases. It is a tangible asset that you can see and touch, and it produces a yield, the crops, that grows with inflation. Now, you don't have to go out and buy a tractor. There are now ways to invest in farmland through specialized funds or REITs that focus specifically on agriculture. You get the benefit of the rising value of the land and a share of the profits from the harvest. It's a very old world way to build wealth, but old world usually means it's been tested by time. In a world of digital currencies and ephemeral tech startups, owning a piece of the earth that grows food is about as solid as it gets. It's a quiet, steady, and incredibly effective way to outpace the printing presses of the central banks. This is the one that always surprises people, but it is actually the most important one of all. The best investment you can make, the one that beats every index fund and every piece of real estate, is an investment in yourself. I often tell students that if they just learn to communicate better, they would increase their value by 50% immediately. I took a Dale Carnegie public speaking course when I was young because I was terrified of speaking in public. That $100 investment changed the trajectory of my life. Why is this an inflation-beating investment? Because no one can tax your talent. No one can steal your skills. If the dollar becomes worthless, but you are the best surgeon, the best coder, or the best salesperson in your town, people will still pay you. They might pay you in new dollars, or they might pay you in chickens, but you will always have a claim on a share of the economic pie because of what you can do. Skills compound just like money. If you get 1% better at your job every month, by the end of the year, you are significantly more valuable than when you started. That extra value leads to higher income, which you can then funnel into the other 6 lazy investments. This is the engine that drives everything else. Don't be so busy watching the market that you forget to watch your own development. Read more, learn a new craft, or master the art of negotiation. These are assets that you carry between your ears, and they are the only ones that are 100% inflation-proof. Let's bring it all home. We've talked about the 7 lazy investments: index funds, tips, dividend aristocrats, REITs, productive brands, farmland, and yourself. If you combine these, you aren't just an investor, you're an owner of the world's most productive forces. But none of this matters if you don't have the one thing that is rarest of all: patience. Let's look at the math one last time. If you take $10,000 today and you put it into these boring, lazy assets and earn a 10% average return, in 40 years, that $10,000 becomes $450,000. If you add just $500 a month to that, the price of a few fancy dinners or a car payment, you end up with over $3 million. You don't need to be a genius to make $3 million. You just need to be a person who can wait. Most people fail because they want to turn $10,000 into $100,000 by next Tuesday. They take huge risks, they get excited, and they end up with zero. The lazy way is the sure way. It requires you to ignore the news, ignore your neighbor's hot tips, and ignore the fluctuations of the market. It requires you to be okay with being boring at cocktail parties. When someone asks you what you're investing in and you say an S&P 500 index fund, they might walk away to talk to the guy who's day trading crypto. Let them go. In 20 years, you'll be the one they're asking for a loan. Investing is the only game where the more you play, the more likely you are to lose. So my advice to you is this: pick your lazy assets, set up an automatic contribution, and then go live your life. Hug your family, do work you love, and let the power of time and the ingenuity of the human race do the heavy lifting for you. It's been working for me for 80 years, and I promise you it'll work for you too. Good luck, stay patient, and remember, boring always wins in the end.